you guys. Okay, so what we're going to do, guys, is we are going to start with chapter 3, and we're going to go through half of chapter 3 today, and then the other half next week. These next two chapters really are about bringing together the culmination of everything you're learning. You know that we're doing the accounting cycle, where we're learning how to analyze transactions or business events and decide, okay, what's happening here? What's an account that's being affected by this transaction? And how much are we dealing with? And is it increasing or decreasing? And then last week we learned about the word, is it a debit or a credit? And we know a debit means what? But, and a credit means, right, that's all it means. Sometimes people think a debit means increase and a credit means decrease or vice versa, but it depends on the account, doesn't it? As to what we're going to do. So, sorry, the computer's just not as fast as I wanted. So I'm going to go down here to chapter 3. And we're going to start with the chapter 3. First half this week. So guys, I want to leave plenty of time so we can have to complete the quiz together. Slideshow. Okay. So the first week we just learned about communicating information to the end user. Last week we learned a little more about these different categories and various accounts linked with those different categories, didn't we? So liability usually has the word what after it? Payable. Payable. And as far as revenues, they're always going to have the word revenue after it, except deferred revenue. Okay. Then we learned how to analyze transactions to figure out the accounts that are being affected and the amounts, and if it's a debit or a credit. Then we learned how to put all those accounts into the form of a trial balance, just making sure our debits equal our credits, because they have to, right? So this week, we're going to learn a little more about something called adjusting journal entries. We know in accounting, we show revenues, not necessarily when we get the cash, but when we earn it, when we provide the service or provide the product to the customer or the client. This concept, called the revenue recognition principle, means revenues get recorded in the period in which the goods or services are provided to the customer. Not necessarily when we get the cash, but when we do the work, when the service is completed, when the goods have been exchanged. The expense recognition means expenses are reported in the same period as the revenues they help to generate. That's called the matching principle. So you might see a multiple choice on revenue recognition and the matching principle. So in this class, you guys paid for spring semester. So the utilities to operate this room or the salaries to teach all get recorded in the same period as the revenues, the tuition they help to generate. So the tuition is the revenue, the expenses all get offset against the revenue in the same period. That's called the matching principle. So we record revenues in the period in which we provide goods and services to customers, not necessarily in the period in which we receive the cash. So here is a great example for you. Here we've got a cruise ship. How many of you guys have ever been on a cruise ship? So what happens is this cruise ship, has a specific day it's going to embark on the cruise. In this example, it's going in April, okay, on the cruise. So in March, they purchased all the supplies for the cruise ship. In April, they paid for all the fuel. And in May, they paid for the salaries. But the revenues occurred when the cruise ship actually provided the service fund for the customers, okay? So in April, when the cruise ship actually was off in the waters, that's when the revenue occurs. So even though in March supplies were purchased, we're not going to record those supplies until April. Why? Because the revenues occurred in April. Therefore, all of our expenses associated with making those revenues also happen in April. So you're wondering, okay, how does that happen? That's what this chapter is about. Most expenses are recorded in the same period as the revenues they help to generate. Other expenses indirectly related to producing revenues are recorded in the period in which they occur. So who wants to take this one? Anybody? You can just read it. Let's see. Which statement best describes when expenses should be recorded? Can it be C? Expenses are recorded when the cost is used to help produce those revenues. Now, in this class, the accrual basis of accounting deals with what I just told you, that revenue recognition and the matching principle. We record revenues not when we necessarily get the money, but when we provide the service or exchange the product. The cash basis of accounting, you can figure out, is just about cash. So the accrual basis is what we're going to learn in this class. Cash basis is we only record revenues when we get the cash, and we only record expenses when we pay out in cash. But for financial accounting, we handle it with the accrual basis of accounting. Most of us, just individuals that have your own checking account, we're all on the cash basis of accounting. But for business reporting, we have to be on the accrual basis of accounting. For expenses, the accrual basis records the expense only in the period the costs are used to help make those revenues. But under the cash basis of accounting, we record those transactions when we actually pay the cash. Do you see the difference? With the revenue, with the accrual basis of accounting, we're matching them. The revenues and the expenses go hand in hand. Whereas with the cash basis of accounting, it gets lopsided. Generally accepted accounting principles require accrual basis of accounting. Okay, make sense? So let's look at some of these. When we provide golf training to customers for cash for $4,300, under the accrual basis of accounting, when are we going to report this revenue? Record this revenue? When we provide the service, right? So on December 12th, we provided golf training to the customers. So that's why we're going to show it on December 12th. Under the cash basis of accounting, we record it when we get the cash. So do you see in this example, it's the same? We're recording under the accrual basis and the cash basis in the same manner. How about this one though? We provide golf training to customers on account for $2,000. We provide the service. We did. That's why we're recording it under the accrual basis. But guys, do you see under the cash basis, we wouldn't even report anything because we didn't get the cash? And do you see how it's really not accurate? Because we really did do the work. But we're not going to record it under the cash basis until we receive the cash. December 23rd, we received cash in advance for 12 golf training sessions to be given in the future for $600. Why aren't we recording this transaction under accrual basis? Why? Anyone?
The services haven't been provided.
The services haven't happened yet. But do you guys see under the cash basis of accounting, we're going to record it, even though we didn't perform the service? That's not the parameter. Under the cash basis of the accounting, the parameter is, did you get the cash? Make sense? Next, pay 1 year of rent in advance for $6,000. Why wouldn't we record that expense yet? We haven't used it. We haven't used that rent. But do you see under the cash basis, we would record that whole $6,000 that month. On December 6th, we purchased supplies on account for $2,300. So under the accrual basis, we wouldn't show an expense until we use it, those supplies. Initially, those supplies would be an asset. And then once we use those supplies, they become an expense. Under the cash basis, we're not going to report that expense because we didn't pay for it yet, right? I got it figured out, but I have one question. Let me just put my computer on hold a minute. Let me just, I'm sorry. Just gonna resume. I apologize. So for the purchasing supplies on account, we wouldn't record either as an expense. One, because those supplies weren't used under the accrual basis. So they're an asset until we use them. And the cash basis, we don't record that because we didn't pay for the supplies yet. Next, when we pay salaries to employees for $2,800, under the accrual basis, we will write that expense off when the salaries, when we owe them. The employees perform the services, they're due the money. It's an expense. Under the cash basis, we would record it because we paid it. Does that make sense? The difference between accrual basis of accounting and cash basis of accounting is all about timing. Under the accrual basis, we record revenues when we provide the goods and services to the customers. And we record expenses with the revenues they help to generate. But the cash basis of accounting, we record revenues when we receive the cash, and we record expenses when we pay the cash. Cash basis of accounting is not allowed for financial reporting. We all want to be on the same page. So one company, to be able to compare the financial statements to another company, we have to have the same rules. That's why we do it this way. Does that make sense? Where did anyone start that sheet of all your names? Oh.
I can start it down this way.
Thank you, guys. And then when y'all are done, will you just kind of wave it in the air so I can get it? So guys, who wants to take this? Which of the following would be recorded as an expense under the accrual basis of accounting? The company purchases office supplies with cash and does not use the supplies. Is it an expense if we didn't use the supplies? No. The company uses utilities in the current period, but does not pay cash. Did we use them? It's an expense. Even if we haven't paid it yet, what would that journal entry be? That we utilize utilities, we received the bill, but we haven't paid it yet. What would we debit? Yes. What would we credit?
Accounts payable.
Yes, accounts payable, we owe the money. The company provides goods and services to customers for cash. That's not an expense, that's a revenue, right? And the company purchases equipment by borrowing from the bank. What is equipment? An asset. Do you see, guys, how it's important? You see how they try to trick you? And how it's important to have each category and write the various accounts under each category? Make sense? How about this? Which of the following would be recorded as an expense under the cash basis of accounting? Hey, doesn't matter that they didn't use them, but they paid for them. That makes them an expense. Good. So guys, let's look at these 4 examples. Now, I'm not going to call on anyone because I want you to feel safe being here. But remember, we're learning. So it's okay to screw up because this is how you learn. But can anyone take number 1? So American Airlines collects cash on June 12th from the sale of a ticket, but the flight occurs August 16th. Determine the date for which the company recognizes the revenue. You said August 16th. You're right. Why, guys? That's when the service happened. Perfect. A customer, who wants to take this one? Yes.
January 27th.
Yes. A customer purchases sunglasses from Eddie Bauer on January 27th on account. Eddie Bauer receives the money on February 2nd. Doesn't matter when we received the money. When did the transaction happen? When did we exchange the goods? Okay. Next, who wants to take this one? Oh, sorry. How about this one? Anyone just can speak it out. Perfect, April 2nd. That's when they received the pizzas and they enjoyed them, right? This is trickier, so I'm not going to make anyone answer this one. The customer pays in advance for a 3-month subscription to Sports Illustrated on July 1st. Issues are scheduled for delivery each week from July 1st to September 30th. So guys, A 3-month issue is about 12 weeks. 1/12 of those revenues will happen every week. Why? Because that's when the magazine was being mailed. Tickets, season holder tickets to the Vikings or to musicals. A season ticket holder, up front, you have to pay the Vikings or hockey or whatever, this huge fee. They won't record it as revenue until each game passes. So if there's 7 home games and you pay $3,000 for those 7 home games, 1/7 will be claimed as revenue after the first home game. 1/7, the second home game. Does that make sense? Okay. So now what we're going to do is talk about something called adjusting journal entries. Throughout the period, be it a year, we're recording transactions as they occur. And these transactions are what we call external transactions. They're happening outside the company. Okay? These adjusting journal entries happen because within the company, we realize we need to make our books current. So there are 4 types of adjusting entries. When there's a prepaid expense, remember like prepaid rent or prepaid advertising, that's really an asset. At the end of the period, we're going to look back and say, hey, how much of that did we use up? So we can adjust what's been used and record it. Or unearned revenue, remember what that is our deferred revenue is the same, is when we got the cash up front, but we haven't done the service. Well, at the end of the period, we're going to look back and say, oh, but out of that $1,000 of cash we received, we have performed $600 of that service. So then what we'll do is we'll adjust our books to show it's not all a liability, we actually earned something. Or accrued revenue. Okay, so what this is, accrued revenue means we're working on a product or a project and we haven't sent a bill out yet. But at the end of the period, we know that we've performed a certain amount of the revenue, even though we haven't sent the bill out or the invoice out. And so we're going to record how much we did complete. So this is where we would debit accounts receivable because we're due the money and show the revenue. Or an accrued expense means we received that utility bill in the mail, but we haven't paid it yet. So don't we need to show that utility bill as an expense and then accounts payable? These are the 4 adjusting journal entries we're going to talk about. The accounting cycle, we've gone ad nauseum about during the year. We take all these external transactions that are happening and we figure out what accounts are being affected and how much, and we do our debits and credits. But now that we're at the end of the period, this is when we're going to record these adjusting entries just to make sure our books are right. After we record these adjusting entries, then we're going to prepare financial statements. Does that make sense what we're talking about today? These adjusting entries to make sure our books are in order, are accurate. Then, after we prepare the financial statements, we're going to zero out certain accounts so we can start again the next period. Now, guys, this prepare the financial statements and record and post-closing entries are going to happen next week. All we're focusing on this week is learning about these adjusting entries. Okay? Make sense? Some transactions have occurred during the period, but haven't been recorded by the end of the period. Sometimes it's using supplies. Or it might be earning interest at the bank. Or it might be rent expiring. Or it might be we owe somebody interest because we borrowed money. So these things are happening even though we didn't get any paperwork, but we need to report those. So here are all of these external transactions we've done throughout the period, and we've recorded them. So what we need to do is do some adjusting entries. So that prepaid rent, guys, we paid up front. We paid a year's worth of rent in advance on December 1st. But that's by the end of the year, which is a month, December 1st, December 31st, isn't 1 month of that rent used up? Right? So since 1 month or $500 was used up just due to the passage of time, we need to reduce our prepaid rent and show it to be rent expense. So we want to accurately show that on December 31st, there's really only $5,500 remaining of prepaid rent. Okay? This is what we call an adjusting entry. This adjusting journal entry will show a debit or an increase to rent expense for $500. And we're reducing our prepaid rent by $500. We're reducing prepaid rent just due to the passage of time. Rent is about being able to utilize building an office, a house for a period of time, and just due to the passage of time, it's being expensed. Or what about this one, guys? We purchased supplies on December 6th for $2,300. But by the end of the period, we used up $1,000 worth of supplies. So you walk into the storage cabinet and there's not $2,300 in there anymore of supplies. There's only $1,300 worth of supplies. Don't we need to show an expense for some of those supplies we used up? So we would debit the expense and we would credit the asset supplies because it's less because we've used them up during the period. Do you see how that's an adjusting journal entry? It's something that happened within the company we need to report. So there's not going to be any paperwork outside the company. These adjusting journal entries are because of internal changes. Make sense? Next one. We purchased equipment on December 1st for $24,000. Now this is a new concept for you guys. When we purchase equipment, it's an asset. We put it as an asset. But due to wear and tear, it loses its value or it's getting used up. And so we have a new term called depreciation, where we expense a piece of that asset each period to show the use of. This using up a portion of an asset, we debit to an expense called depreciation expense. And this is a new term for you guys. This accumulated depreciation is an account that is offset against equipment to show how much of that equipment we've used up in this period. Okay, so what we do with this accumulated depreciation, we call it a contra asset account because it connects with equipment to come up with a net amount. I don't want to give you too much and overwhelm you, but no, this is a way we use up an asset. So here we're going to look at, on November 30th, here are our balances. on December 31st, here are our balances. It's telling us that we purchased supplies in December that totaled 4,500. So let's just look at it this way, guys. Let's pretend this is a supplies account, okay? This is a supplies account. I probably should do it on my computer so everyone can follow me. Sorry. So let's get an Excel out. So we started with $2,000, we ended with 3,500. File new. Blank worksheet. Okay, we're not going to do it that way. Let's do it this way. Oh, maybe they want me to sign in to do this. Excel, go back into it. Sign in. You know what that they haven't set this computer up to use. So, okay. So those of you who are watching this, again, I'm sorry, I'm creating a T account. And this T account starts with a $2,000 debit to supplies. We know it ends with a $3,500 debit to supplies. It tells us during the year, we purchased supplies in December totaling 4,500. Okay? So guys, how can it be we started the year with 2,000, we purchased 4,500 during the month, or we started the month with 2,000, we purchased 4,500 during the month. This is $6,500, right? But we ended with 3,500. What had to have happened? There had to have been an adjusting journal entry of a credit of $3,000 to this account to end up with a balance of 3,500, right? Am I making sense? So what had to happen was we had to use up. We've used up $3,000 of supplies. So we debit supplies expense of $3,000 and we credit our asset of $3,000 because we've used them up. We don't have that anymore. Does that make sense why that account would have gone down? That adjusting journal entry is something we do at the end of the period to make sure our books accurately reflect what's going on in the company. Okay? Next, it says to us, next one is our prepaid insurance started at 8,000. Our prepaid insurance I'm doing a T account. I'm showing prepaid insurance. We paid upfront $8,000 at the beginning of this month. But by the end of the month, we only have 6,000 remaining. What journal entry did we do for it to go from 8 to 6? We had to have credited this asset by $2,000, right? Why? Because just with the passage of time, insurance expires, doesn't it? Just due to time. We pay insurance for a period of time. And if nothing goes wrong, great. But we still have that insurance for the what ifs. So at the end of the period, we're going to debit our expense called insurance expense, and we credit our prepaid insurance because we don't have as much of that asset anymore. We've used it up. Next one. $11,000 is paid to employees during December for November's salaries. Okay, so let's look at this one, guys. So we've got salaries payable here. Now, why do we have a salaries payable? Don't we have it because we owe somebody something, right? So as of November 30th, we showed 11,000 of salaries payable. Now they're telling us that in December, we did pay that 11,000 that was due in November. So we did pay that 11,000. So this credit plus this debit would end up at zero. But why are we then showing the 16,000? What kind of journal entry would we have reported to show we owe 16,000 of salaries? Wouldn't it be salaries expense of 16,000? In other words, employees did the work. They're due the money. Therefore, we show the expense and we credit our salaries payable because we're probably not going to pay them till the next month. Okay? Make sense? Last one. On November, so we have an account here. I love doing T accounts, as you can see, because instead of me having to think it, I get to visually look at it. So this account is called deferred revenue. Now, guys, what is deferred revenue? Isn't it when we received cash in advance and we haven't provided the service yet or whatever? So this deferred revenue began with 3,000 and it ends with 1,500. On November 1st, a tenant pays Golden Eagle $4,500 in advance rent for the period November through January. So how many months is that? November, December, January, 3 months. The $4,500 was paid on November 1st. So by November 30th, 1 month had been used up, which is why we're at 3,000. Oops, sorry guys, 3,000 here, right? What adjusting journal entry did we do to get down to 1,500? Wouldn't we have debited this liability account by 1,500? Wouldn't we have adjusted it? Because they gave us that money up front, it's a liability until we earn it. So the company owns property that the customers rent. So the customer gave money up front for the whole 3 months. Due to just the passage of time, our rent becomes revenue. It's now earned. So now that 1,500 for the month of December becomes service revenue. So don't we reduce our liability? And we credit our service revenue for 1,500? Does that make sense, guys? Yes? Who wants to take this one? Which of the following is recorded when an adjusting entry associated with a prepaid expense?
You credit an asset.
When you have a prepaid rent or prepaid advertising, and we use it up, what do? To show it's now an expense and we're reducing that asset, what do? You credit the asset because you don't have as much anymore. You're reducing it. So you would absolutely credit the asset. Make sense? How's everyone doing? All okay? Anyone need a break? Did that paper go around? Thank you. Thank you so much. Did everyone get to sign it? Just so you know, just so everyone keeps track, I will show, even though you're not getting graded for it or anything, you'll see in the grade book attendance and you'll see your name in there, okay? That's why I do it. So now we're going to talk about this depreciation, where we use up a piece of an asset. So, whoops. It just says recording depreciation. You know what deferred revenues are. Okay, I think we're going to spend time doing some homework so we can go through this. No, I think I'll go back to this. Okay, so when, in this case, on November 28th, 2018, Shocker receives a $4,500 payment from a customer for services to be rendered evenly over the next 3 months. Deferred revenue is credited. So guys, what I do first is I go, okay, what does all this mean? What it means is Shocker's the company that has obviously owns a building, received $4,500 up front for 3 months of rent. So if you think about it, cash was debited, deferred revenue was credited at that time. Now, 1 month later, because as of December 31st, 1 month later, isn't 1/3 of this used up? So wouldn't we show a debit to deferred revenue and a credit to service revenue? So now we've earned it. Just due to the passage of time, that rent is now earned revenue. Make sense? Yes? How about this one? On December 1st, 2018, the company pays a local radio station $2,700 for 30 radio ads that are to be aired 10 per month throughout December, January, and February. Initially, prepaid advertising was debited for the whole $2,700. So if 1/3 of this prepaid advertising has been used up, wouldn't we take and debit advertising expense for 1/3 of that? And we would credit our prepaid advertising to show we don't have that asset anymore. We've used it up. Yes? Employee salaries for the month of December totaled 8,000. They're going to be paid on January 7th. Have the employees worked? Are they due money? We used them, it's an expense. We debit salaries expense and we credit salaries payable. We owe them money. But the service, their work actually did happen in December. That's when we're going to report it. Okay. This is an interesting one. On August 31st, Shocker borrows $70,000 from a local bank. A note is signed with principal and 9% interest to be paid on August 31st, 2019. Now, guys, August 31st to the end of December is how many months? Anyone? How many full months? 4 months. So we have incurred interest of 4 months. The way we determine how the interest is accrued is we take the amount we owe, which is 70,000 times 9%. Is it 9%? 9%. So a whole year of interest would be how much? 6,300, wouldn't it? 70,000 times 9% is 6,300, right? So each month, if we took this 6,300 and broke it down by 12 months, how much is that a month? Anyone have a calculator?
It's 525.
Thank you. So 525 is the amount of interest expense that accrues each month. How many months do we have to report it for? 4 months. 525 times 4 months has to equal the 2,100, right? So do you see how we debit our interest expense for 2,100 and we credit our interest payable for 2,100? Yes, no? Does that make sense? Okay, now accrued expenses are recorded when a company has a cost that is used to help produce revenues, just like that interest, but hasn't yet paid cash for that cost. The cost gets recorded as an expense and the amount owed is recorded as a liability. We did that with interest and we also did that with salaries, didn't we? Make sense? Yes, no? So remember, the employee earns the salaries. The salaries are owed at the end of December, but they're not getting paid until January 4th. So the amount that is due those employees as of the end of December, we show a debit to salaries expense and a credit to salaries payable, don't we? Who wants to take this one?
I can do it.
Okay.
I think it's D.
So if a company pays an employee $100 per day for a 5-day work week that runs Monday through Friday, and December 31st is a Tuesday, What is the amount of the salary adjustment, assuming that payday's on a Friday? So you said D because it's 2 days. Do you guys agree? Monday, $100, Tuesday, $100, the end of the month. So that's correct. It will be D, and it will be a debit to salaries expense and a credit to salaries payable, won't it? Make sense? Again, utilities get used up, but we're not going to pay them till the next month. We owe that money. Therefore, we debit our utilities expense and we credit utilities payable or accounts payable. Okay? Interest is the same way. We borrow money, we owe interest. Therefore, we show the interest expense and then the interest payable. It's an accrued expense that hasn't been paid yet. Does that make sense? When recording the interest payable on borrowed amounts, students sometimes mistakenly credit the liability associated with the principal amount called notes payable. Remember, we record interest payable in a separate account. We call it interest payable. So we keep the amount we owe, the note that we owe, separate from the interest we owe. Okay? How about this one? I want everyone to attempt this on your own. Okay? If a company borrowed $20,000 on November 1st at the rate of 6% annually, you're going to figure it out like I just did up here. How much interest should be accrued at the year-end date of December 31st, assuming no accrual has yet been made this year? How many months are you going to accrue for? Two months, right? Anyone have the answer?
200.
I'm sorry,
200.
200? So we take our 20,000 times 6%, and that interest rate is always shown over a 12-month period. Divide it by 12 months, multiply it times 2 months to come up with interest expense 200, interest payable 200. Great job, guys. Accrued revenues, when a company provides products or services to a customer that hasn't yet received cash, it records the revenue and an asset for the amount expected to be received. So let's look at this. By the end of the year, services of $700 have been provided to customers, but we've not billed it yet or invoiced them. So we are then going to show an accounts receivable, which means money due the company, and a service revenue. We provided the service, that's when we recorded, even if we didn't get the cash, correct? So then once we do receive the cash, it's at that time we'll say a debit to cash, a credit to the receivable. Got it? Adjusting entries are unnecessary for two types of transactions. Transactions that do not involve the recognition of revenues or expenses, and transactions in which we receive cash at the same time we record revenues or pay expenses. So in those cases, we're not going to ever do an adjusting entry because they're not needed. Okay? Now, after we go through all of these adjusting entries, remember throughout the period, we analyze these external transactions and we record them with debits and credits and accounts. And then we create this trial balance that you guys did last week. All right. Now what we do is any adjusting entries we need to take care of get now recorded. And then we do what we call an adjusted trial balance. The adjusted trial balance is just, again, a list of all account balances after we update them with the adjusted entries. We prepare this adjusted trial balance, and we're going to use this adjusted trial balance to prepare our financial statements. Does that make sense? So we're not going to go here to financial statements. That's going to be next week. We've got enough to cover for this week, right? So let's take a look at some of the homework problems. Is that annoying? Should I shut the door? So. Chapter 3 homework. I'm going to shut it. Well, I'll have him shut it when he comes back. Okay, let's look at this. For each transaction, determine the amount of revenue or expense, if any, that is recorded under the accrual basis accounting or under the cash basis of accounting. So we kind of went through this earlier, didn't we? I think that is pretty self-explanatory. Let's look at this next one. Corn Frogs Fine Cooking maintains its books using the cash basis of accounting. However, the company recently borrowed $50,000 from a local bank. Yeah, we got class in here, guys. Corn Frogs Cooking maintains its books using the cash basis of accounting, but because they borrowed money, the local bank requires the company to provide annual financial statements prepared using the accrual basis of accounting as part of the creditworthiness verification. So they're showing us the cash that was paid for salaries, supplies, repairs, insurance, and advertising. So if they paid for those, then we know under the cash basis, they're recording them all as an expense. And then it tells us you're able to determine the following amounts. It shows us what the accounts receivable was on January 1st, 2024, and then 12 months later on December 31st, 2024. So what they're telling us, guys, is that they received some revenue and they didn't necessarily get the cash right away, did they? Right? Right, make sense? So do you see here, they collected 65,000 from customers, right? But it looks like some of this money that they showed us cash collected from customers was really earned in the previous period. And they received the cash in 2024. The reason I can tell that is since accounts receivable went down 5,000, wouldn't that mean they were due cash and they got it? Make sense? So to me, this service revenue of 65,000 shows the cash that was received. But for our purposes, they only really earned revenue of 60,000 in 2024 because 5 of it came from the previous year. Does that make sense? So won't we show our service revenues to be 60,000? Wouldn't we? Oops. Goodness gracious. Okay, that makes sense? And maybe I need to say total revenues. Let me just see. Okay, now expenses. One thing I see here, they show insurance expense of 4,000, don't they? You see that? Do you see our prepaid insurance was at 1,700? And then it went up to 4,200? Does that make sense? So we had 1,700 of prepaid insurance and it went up to 4,200. So how much would that have been? 4,200 minus 1,700 is what? 2,500? Right? So shouldn't insurance expense really be 2,500 under the accrual basis? Do you see how I'm figuring that out? Under the cash basis, they write it all off. They paid about 4,000 in insurance. But if we know the prepaid insurance began at 1,700 and then increased to 4,200, doesn't that mean 2,500 of this 4,000 went into insurance expense or prepaid insurance? Therefore, the difference, the 1,500, should be an insurance expense. Right? Yes? No? How are you doing? I told you this is the hardest chapter. Okay? Next one. Look at our salaries. Do you see our salaries started at 4,200 and at the end of the year that they're down at 2,800? You see that? What's the difference there? 1,400? Right? So when they say they paid 23,000 in salaries, wouldn't 1,400 of that been from the previous year since it went down? So 23,000 minus 1,400, is that 21,600? Yes, no, 21,600? Let's see if we're right so far. Okay, next. Look at this one. Supplies. We started the year with 0 in our asset supplies. We ended the year with 2,000. But we know we paid 9,000 in supplies. Wouldn't that be we used up 7,000 of supplies? Right? Wouldn't this be a supplies expense of 7,000? This will be a perfect discussion question. So if you have a question on this, right, hey, for problem number 2, can we talk about this so we can go through all the details of how we're figuring this out, okay? Now, repairs and maintenance. I think repairs and maintenance of 8,000 would be repairs and maintenance expense, 8,000. Repairs and maintenance expense, 8,000. I don't see any accounts payable there. Shouldn't our net income be? So our net income, what's the difference from 60 to 38.1? 21.9? Nope, I'm wrong. Are we missing an expense?
Advertising expenses.
Oh, thank you. Yes, advertising of 6,000. Advertising expense, 6,000. So 60 minus 44.1 is what, guys?
15,900.
Thank you, guys. Does that make sense? If you have problems with this, guys, use this discussion and ask questions, and then Stuart or I or other students that get it can go into detail how we're figuring this out, okay? Next, I just want to, I think I need to leave enough time for the quiz. Do you guys want to do a joint quiz or should I keep doing this?
Keep doing this.
Keep doing this? Who wants to keep doing this? Perfect, we'll just keep doing this, okay? So you'll take your quiz on your own. But this is gonna help you. You still might have some questions, but at least you know what the right track is, okay? Here we have information for preparing year-end adjusting entries for Bearcat Personal Training Academy. So we've got some different expenses here that we need to record the adjusted journal entries for them. It says, at the end of the year, Bearcat calculated that it owed $24,000 in income taxes. Those taxes won't be paid until next April. What happens when we're aware something is due? It's an expense that happened, but we haven't paid the cash yet. What do we debit and what do we credit? Any ideas? Anything? Let's do another one. But this one. Salaries owed but not yet paid to employees for work from December 16th through December 31st are $4,000. Record the adjusting entry for the salaries at the year end. We've done this one before. What would we debit?
Salaries, expenses.
Salaries expense. Of 4,000. And what do we credit? We owe the money. Salaries
For
payable,
salaries.
4,000, right? You guys get that one? Guys, why would this not be any different? Wouldn't that be the same logic? At the end of the year, Bearcat realizes it owes 24,000 in income tax. Those taxes aren't going to be paid out for a while. Wouldn't we do it the same way? Wouldn't we do income tax expense for, shoot, 24,000? And wouldn't we do income tax payable for 24,000? That income tax is a result of the revenues they earned in this period. Therefore, that expense is going to offset those revenues, right? Next. On March 1st, 2024, Bearcat lent an employee 20,000. The employee signed a note requiring principal and interest at 9% to be paid on February 28th, 2025. Record the adjusting interest entry for interest at its year end. How are we going to do this one, guys? This is interest that we don't owe. This is interest that's due to us, right? Because we're the employer. We lent an employee money. We need to show how much interest has been accrued as interest revenue, right? Right? So I'm going to give you one thing and you're going to figure out the amount. This should be interest receivable because it's due us, and interest revenue. This is money we are receiving in February. I want you guys to figure out the amount. Everyone try, okay? This is the only way, guys, if you could learn accounting without practicing, I'd be doing it. But I don't know a way apart from practice, okay? Because you become familiar with the various types of entries. Okay, you guys are gonna try that. Anybody have a number yet? Anybody?
1,500,
How much?
1,500.
So tell me how you figured that out.
I did the 20,000 times the 9% and then divided it by 12. And then I figured the 10 months between
10 or 9? Yep, 10.
10
Sorry.
months. And so did 150 times 10 and got 1,500.
How many agree? Perfect. Does anyone have a question how this was figured? That's why we're here, guys. Ask questions. Remember, you're learning. This is how we learn. So we're going to say here, interest receivable, 1,500. Interest revenue, 1,500. Okay? Got it? Okay, let's look at number 6. So Bearcat received 2,700 from a customer on October 31st, 2024 for 3 months of personal training that began on November 1st. Brian credited deferred revenue on October 31st at the time of receipt. How many months have passed?
Greater is it two?
2. All November and all December. Remember, we're on December 31st right now. Okay. So 2 months have passed. How many months is this training for?
3.
3. So how much have we earned? Well, 2,700 is for 3 months. So haven't we earned 1,800 of it? So initially they debited cash, they credited deferred revenue. Aren't we going to show this? Let me find new transaction list. New journal entry. I'm just trying to. Aren't we going to, for number 6, debit deferred revenue to reduce it for 1,800? And won't we credit service revenue? Because now we've earned it, haven't we? Yes, no. Make sense? You're going to do the same thing here. The job is to learn how to go about processing these journal entries, okay? Same concepts. Next. This one, again, journal entries. They give us the balances. They give us on January 1st of 2024, all of these balances at the very start of the year. Then they show us these various transactions throughout the year. Then it says the following information is available for the adjusting journal entries. Accrued interest on the notes payable at year end amounted to 2,500 and will be paid on January 1st, 2025. Accrued salaries at year end amounted to 1,500 and will be paid on January 5th. Supplies remaining on hand at the end of the year equal 2,300. So what we need to do is show these various transactions based on all this information. So when it says we provide services to customers on account for $62,400, what are we going to do? What do we debit? What do we credit? We didn't receive cash, so cash isn't debited. But when we don't receive cash, what do we debit? Accounts receivable for $62,400. And what do we show here? Service revenue for $62,400. Always check your work. Next, we provide services to customers for cash. What are we going to do here, guys? We debit cash for $75,300, and we credit service revenue for $75,300, don't we? Got it? Next. Collect on accounts receivable $45,700. What does that mean? We got the cash for people that owed us money. So when we get the cash, what do we debit? Cash for, sorry, what is it? $45,700. And what do we credit?
Accounts receivable.
Accounts receivable. They don't owe us that money anymore, do they? Right? They paid it. Five, issues shares of common stock in exchange for $30,000 of cash. Debit cash, and what do we credit? Common stock. So you're gonna keep doing this, keep working there. Next, we've got various information that you have to prepare an unadjusted trial balance. We've got reporting journal entries again. You see practice, practice, practice. And then an unadjusted trial balance. So what you'll do here is we have the balance at the beginning of the year. We know these transactions are taking place. So for example, with cash, we know what we started with. And then we look at the various transactions that affected cash. Okay. And we can start with the 41.5. We add our 75.3. We're going to add our 45,700 because we collected that on accounts receivable. We received cash of 30,000 from common stock. We paid on account 11.3, cash reduces. We paid in salaries cash of 64.2. We paid 22.5 in advertising and 2,900 in dividends. See what I'm saying? You see how you can go through and find out your ending balance. Another way to do it, the best way to do it, is to create a bunch of T accounts. And then record the journal entries and post them like we did last week. Okay? That's your homework. Okay? Your quiz is going to be very similar to your homework. The key is understanding these adjusting journal entries. So then next week, when we prepare the financial statements, our books are accurate. Any questions before we end, guys?